Good afternoon, everybody. Thank you for listening in today or being here in the room, actually being in the room. Let me start off by doing a little straw poll. How many of you think that interest rates are going to rise? How many of you think interest rates are going to rise? About 2/3. How many of you think that the stock market is either fairly or overly valued? Stock market fairly or overly valued, much less, maybe about half the people. So we've got about 2/3 of you think inflation and interest rates are rising, about half of you think that the stock market is fairly or fully valued. I'm here today to talk about alternative credit, private debt, where we think you can get a very high double-digit return that is inflation protected because the rates are floating rate by and large, and where you have the protection of being in a debt security and have very good capital preservation. So with that, Marty, why don't you start taking us through the deck here. I'm just going to spend a few minutes on the market. I'm going to spend a few minutes on us, and happy to open up for questions. Happy to chat with anybody later about us. So we are a leading independent middle market credit platform. I've been listening today all about how banks are being disintermediated. This has been going on in our space for decades now, as commercial banks leave the space of lending to small and mid-sized businesses. That industry is now left to folks like us who can make these loans that are very attractive. We founded PennantPark about 15 years ago. I've been in the business 35 years. I started off long ago at a place called Drexel Burnham. Some of you may remember that. Most recently, before starting PennantPark, I co-headed the credit business in Apollo. And today we have assets of over $5.2 billion and about a 50-person team. We've had an excellent track record over that nearly 15 years, which includes the global financial crisis, the energy downturn, and most recently COVID. Across all of our investments, we've delivered a double-digit IRR at the asset level, excluding any leverage that we put on these vehicles. We increase those returns by co-investing in the equity of these small and mid-sized businesses, so that the blended return can be quite attractive. We've got a very senior team, 11 of us, average 24 years in the business. We've been together a long time, both at PennantPark and before. That gives us a repeated, demonstrated origination track record where we get all the looks that we want. We've got a culture of integrity and transparency and alignment of interest. Very rigorous underwriting, documentation approach. We're highly selective about what shows up in these portfolios. And then when things go wrong, and they do, we've got really good expertise restructuring and doing the workouts to get our capital back. All of those things have combined to create the returns you see in the middle of the page in the circle. We have two strategies. We have an opportunistic debt strategy, which is kind of a strategy targeted to deliver a team's return. And then we have a senior strategy where it's a lower risk strategy, depending on the leverage investors choose. It could be an unlevered 7-8% very safe return, or it could be double-digit return in a leverage strategy.
Next page.
Yep, next page. So here's our performance through COVID. You can see in our different strategies what we've been able to do. On the left-hand side are our two credit ops funds, PCOF 2 and PCOF 3, 29%, 30%, and 22% returns respectively during 2020. And even our senior vehicles, which are set up to be even more secure, lower risk, very attractive, 17%, 11% returns in 2020. And that's compared to the various benchmarks that we compare ourselves to, including the Cliffwater indexes, the high yield index, and the leveraged loan index. So, you know, our goal is first, capital preservation; second, drive safe, steady yield; and third, create the upside. We were able to do that very nicely in 2020 during COVID. Then you go back to the global financial crisis. We were in business 15 years ago. It seems like it went in a snap. We just got in business in 2007, and the global financial crisis hit. We also have a very strong track record through the GFC, and you can see a very nice increasing double-digit return, 12-13% more as the GFC matured. So in some ways, we almost do better in a market where there's challenges. Our downside orientation, our conservatism, really shows itself in times of challenge.
Next page.
Here's a vintage track record year by year over the last 14 years. Dollars invested, IRRs, which includes the GFC, includes the energy downturn, includes COVID, and our two strategies, the senior debt strategy on the left-hand side of the page, the opportunistic strategy on the right-hand side of the page. Senior debt at the asset level through all of these times over an 8% return at the asset level. Very strong for first lien senior debt. An annualized default rate of 0.3%. Only 14 out of 471 transactions defaulted. By the way, for us, when a default happens, that doesn't mean it's going to zero. That means the company does not pay interest. Sometimes we come to an agreement with that company. Sometimes we convert debt to equity. Sometimes we take control. And we've had a very good track record of managing losses. When we have to deal with companies to take control, we've got a good track record of getting our money back. Opportunistic, again, a higher deal strategy, only 18 deals out of 317 defaulted. Annualized default rate of 0.5%. So a very nice track record over the course of time. You should be aware of vintage. Vintage is an important thing in our business. What we do is basically invest in illiquid instruments. So the vintage that we're in is important. We can't turn around tomorrow and call our local broker dealer to make a liquid market. We have to really underwrite. Knowing and understanding what we're buying is really illiquid. So that's why it's important to understand vintage. What's the vintage you're in? 2019, by definition, was a more challenging vintage. Our market was fairly buoyant. COVID happened in 2020. That vintage, we and others needed to be more conservative and cautious. 2009, on the other hand, right after the GFC, that was an all-time great vintage. Yield levels were high, leverage levels were low. So just to be aware as investors in the private or liquid asset classes, whether it's private debt or private equity, I advise you to understand vintage. And it's important. We're certainly aware of the vintage we're in. When others are greedy, we are fearful, and we're fearful when others are greedy, to take the phrase, and we need to be aware of that in our market.
And Art, just to clarify, when you're talking about leverage loans, are you talking about CLOs, CMBS structured products, or what?
Yeah, so the question from Marty is, what are we talking about here? We originate, diligence, document, and then own the loans.
Okay.
And we own those loans in various packages. We own those loans in GPLP commingled funds. We own those loans in middle market CLOs. We own those loans in BDCs. We own those loans in SMAs that we have for certain large investors. So our business is the origination, diligence, documentation, and then monitoring those loans when they hit the portfolio. And then again, when something goes wrong, we have to do what we need to do to manage the capital. In certain cases, we need to take over those companies that have declined to pay us their cash in.
In any cases, are you actually underwriting the loans, or
well, the question being, so Marty asked the question, do we underwrite those loans? Do we then sell to third parties?
Correct.
Is that the question? Occasionally, our large limited partners, they do want co-invest. So they say, hey, I'm coming into your GPLP commingled fund. Can you give me some co-invest? And in certain cases, we will allocate co-invest to certain investors. But by and large, we originate to own. It really focuses the mind. We ourselves personally own large percentages of the funds ourselves. Each year, our investment professionals are asked to and take 30% of their bonuses and invest them into the funds, so that we are all eating our own cooking. And this is a conservative credit culture that we have. The most important thing we need to do is preserve capital. If we preserve capital, usually the upside takes care of itself, and we've managed to do that now. Okay, so I'm now going to lay out more to Marty's question. Where are we focused? Where are we focused? We are focused on what we call the core middle market. For us, the core middle market are companies that do EBITDA, earnings before interest, taxes, depreciation, and amortization, of between 10 million and 50 million. 10 million and 50 million is where we are focused, where our capital is not commoditized, where we can do the right diligence, we have the time to do the right diligence, we can negotiate covenants that have meaning and protect ourselves, we have substantial equity cushion beneath us to protect our capital. And when something goes wrong, we can be at the table to preserve our capital and to manage the outcome. Why is 50 million the threshold and above 50 million? There's two groups of very voracious forms of capital that we do not like competing against. One of those forms is the broadly syndicated loan market, much of which is in BSL CLOs. They set themselves up specifically to buy whatever's in the market. Those folks are not negotiating covenants, they're stretching leverage, the equity cushions are thinner, and they make decisions very quickly. The other form of capital above 50 million EBITDA are the large global Goliaths of alternative assets who have 20, 30, 40, 50, 60 billion of what they call direct lending assets. Those direct lending assets are channeled towards those $50 million and above companies. Again, two forms of capital that are forced buyers. We do not like to be up against forced buyers. We like to be up against or in situations where capital has meaning, where we can do the proper due diligence and construction of that deal. So we're focused on the core middle market. I'll drill down deeper in a minute on that. Typically, the terms LIBOR, it's going to be SOFR, LIBOR plus 500 to 700 on senior debt. We get a couple points of original issue discount on our upfront fee. We get some call protection. We get some equity co-invest to get the equity upside. I'll go into co-invest.
Next slide.
Next slide. So here we drill down more into what we call the core middle market. And we have focused more on that core middle market over the last, I'll call it 6 years. You know, we have this culture at our firm of continuous improvement. What's going right? What's going wrong? How do we improve? What lessons do we learn? And we realized about 6 years ago that we were getting better risk-adjusted returns with somewhat smaller companies, below 50 million EBITDA, and even better yet, companies that start out at 10 to 20 EBITDA. They start out at 10 to 20 EBITDA, but they have a growth plan. The growth plan is out on acquisitions. The growth plan could be organic growth. And when we find those companies that have a strong growth plan, we can lend to them while they're at 10 to 20 EBITDA, where our capital is again differentiated, where we can co-invest in the equity of those companies. So we're providing the loan and we're co-investing in the equity, and there's an agreed upon plan of growth. That's, in some sense, that's the best of all worlds. We have substantial equity cushion, our capital is preserved, we're getting good yield on the debt, and our debt is fueling the growth. We're participating in the equity upside with the equity co-invest. So here on this slide, you see on the upper left, since 2015, fully 70% of what we're doing is in companies below 50 million EBITDA, and 37% is below companies of 20 million EBITDA. That's up substantially from what we were doing prior to 2015. On the upper right-hand side, you can see the EBITDA growth during our hold period. If you look across our portfolio, the EBITDAs have grown across the portfolio and all deals 25%, which is really nice. When you're a lender, which is kind of what we are, flat is okay. All we really want to do is get our money back as a lender. 25% growth is really good, and our below 20 million EBITDA deals, the growth has been 80%.
Does sector matter at all?
So, Marty's question is sectors. Does sector matter? Yes. We are focused on 5 key sectors where we think there's very strong free cash flows that we can underwrite, where we've had a really good track record, where we can be among the smartest people in the room. We know the right questions to ask, and they've been steady, stable cash flow generators. Those sectors are government services, healthcare, software technology, business services, and consumer. Those 5 sectors have delivered most of the value, and that's where we have deep expertise. At this point, that's where we're sticking. Of course, we're always on the outlook for new sectors where we can learn, and we have to be very vigilant about our existing sectors. And if they change, we have to be on top of it. You know, when I got into business a long, long time ago, people used to think that investing in newspapers was a great steady cash flow business. It was a great steady cash flow business until it wasn't. People used to think software was a risky business. We now know that software has some of the most embedded cash flows you're going to find. No one ever rips out software from their computers these days. So even though we focus on these 5 key sectors, we have to, you know, be really on top of it, make sure that we're on our toes about those 5 sectors, and also be on the lookout for new sectors or where characteristics are going to change. The most challenging thing for all of us these days, and we've been talking about it today, and I've listened to this meeting, is secular shift, secular change. the world changes and it changes faster and faster than it ever has. And then you have things like COVID or the global financial crisis, the energy downturn, and that change accelerates. So all of us need to be very on top of change. And if we have a traditional business or we're investing in traditional business, we have to be open-minded to where's the disruption coming from? Are we going to be part of a disruptor? How do we deal with disruption? Or are we going to be investing in a disruptive entity? So, ultimately, we're lenders. By and large, we want capital preservation first and cash flow. We like to have some of this equity upside, or we can be on the cutting edge of disruption. That's why we had 29% returns in our opportunistic vehicles during COVID.
So we look at a lot of credit funds. Do any of these things matter to you, like duration, or when you're looking at these loans, like re-upping, like you've had somebody who's performed, as you were saying, profit has grown, but you like it even if it's just flat because it means they're paying their debts.
Yeah.
Do you re-up with companies that continually, take out debt?
Yeah.
You like those tranches, or?
Yeah, so look, Marty's question is, do you stick with the same companies again and again?
Yes.
And the answer is, you always have to have a fresh pair of eyes, right?
Okay.
Just because a company's performed, been a great performer for you, every day you need to re-underwrite that. Certainly when it comes up for a redo or a refi, you have to be asking these questions. Sometimes we've gotten burnt by staying at the party too long.
Sure.
One thing you have, let's stay on this slide.
Yep.
One thing you do have, I need to point it out here, given what's going on with inflation, rising interest rates. 95% of what we do is floating interest rate. So if you are concerned about inflation, if you're concerned about rising interest rates, we're very well protected in this asset class. The only other points I point out here is really to the lower right. We do modulate, we do have the ability to take lower risk with smaller companies. Our average debt to EBITDA on the below 20 million companies is about 4.2 times. Our average debt to EBITDA across the portfolio is about 4.9 times. So that's the nice thing about how we underwrite our portfolio. Each loan can be bespoke, tailored to the situation. It's not a commoditized business, and we really try to be very careful about what we do.
Do you invest across different tranches of the same loan? Or, so we had like Phil Daraboff, you probably know, he's a Wharton guy, and he had a CLO fund years ago. And, he was always saying that for family offices, there's a specific, tax advantage. Do you look at things like that, or is you're pretty much looking at the same thing across?
So it's a good question. We have these two strategies, opportunistic and classic senior debt. So opportunistic is a little bit more of a yield strategy, high yield strategy.
Yep.
So occasionally we'll buy the second lien, we'll buy the mezzanine, we'll buy the subordinated tranche. That will not fit our senior strategies. That may fit our opportunistic strategy.
Gotcha.
So we are also very cognizant, Marty, of not having different funds and different layers of the capital stack. So we will not have one fund in the senior debt and another fund
Interesting.
in the sub debt, because that's a potential conflict of interest.
Gotcha.
So the funds do co-invest side by side in many cases, but we won't have different funds in different tranches.
And this marketplace, leveraged loan market, did pretty well in 2008. I mean, you've already marketed it well in the last turn down, but
well, look, I mean, let's face it. I mean, people are shocked that this marketplace does well. This is a less risky place to be than equity. Of course it is. It's debt. It's senior. It's secured. It's top of the capital stack. Yeah, of course it's going to be less risky. People are like, well, can't there be defaults? Well, if there's a default, our downside is we then own the equity. That's our downside. So relative to equity, of course it's going to be lower risk. I think there's some old school thinking that this is a high risk sector, but let's face it. What's the quote? Lending is kind of the world's second oldest profession. People have been lending for many years. This is bank debt, guys. Bank debt. You can do different things with it. You can get higher yields. You can tailor it. You can make it much more bespoke. But banks used to do this. They don't really do it anymore in the middle market.
Sure.
Yeah.
Question: Has industry composition changed much over the last few years?
Well, last couple of years, sure. I'll give you a great example. The deal comes in the door 4 years ago that sells furniture on the internet. Right? An old guy like me says, "Who was buying a sofa on the internet?" Right? I said that. And you did, and we went around the investment committee table, and we have all of our whole team from young to old in there. And basically anybody below the age 35 raised their hand, just like you look like you're below 35, so good for you. So all the 35 and below people raised their hand. They would buy sofa on the internet. So thankfully, we listened to them, and we did the deal. And of course, that company that sells furniture on the internet did very well going into COVID. And then, of course, during COVID, it did super, super well. And we've had a terrific return on both the debt and our equity co-invest. So we co-invested in the equity. We've had 4 times our money on the equity so far, and we still own a significant chunk of that company. So this is the point of you have to constantly re-underwrite, and constantly, just because we pitch, we've been in the business a long time, we have, but that really teaches us we have to. It's a humbling business. We have to stay on our toes. We have to continue to learn and see what's new.
And just, we're typically investing in common equity in leverage transactions as well. How you also want to prevent being a sort of a competitor to your sponsor client side.
Yeah.
So
So that's a good question. The question is you do debt, you do equity. You have our biggest borrower base are middle market financial sponsors. Those are the folks. There's 2 enormous market in the United States. We think there's over 2,000 middle market financial sponsors. We actively cover over 600. Feet on the street, developing trusted relationships. This is not a business that you do through Instagram. And this is like personal relationships, and we cover that. So our equity investments are co-investments. We do not turn around the next day and say we're competing with them. So primarily we're a debt provider, and then we co-invest in the equity. Did that answer your question?
We have about 2 or 3 minutes left.
Great.
Next slide.
So here is a slide. There's a lot going on in the slide. Back to the vintage point. Understand your vintage. So there's a bar chart at the bottom of this slide, which shows debt to EBITDA. Debt to EBITDA over the last decade, 2011 to today. Compared to broadly syndicated loans, middle market loans, which are below 50 million EBITDA companies, and PennantPark. So the dark blue, those in the audience can see, the dark blue is broadly syndicated loan market. The turquoise is middle market. Purple is us. Because we are not obligated to buy the market. We select credit. We only want to invest in deals that we want to invest in. We've successfully, in the purple, kept leverage lower than the market. If you go to the line chart in the middle, you see the yield. You see the yield. Again, the purple is us. So we've managed over a decade to take less risk, to have substantially lower debt to EBITDA, and generate a higher return because we can be selective. We do not need to buy the market. I would like to point out that in 2019, pre-COVID, our leverage levels were substantially below the market. Average debt to EBITDA for the middle market was 5 times. We were 4.5 times. That set us up very well to protect, preserve, and actually make money during COVID. So the returns are okay. Next slide. Unless you have a question, Mark.
No, I think we're good.
Defaults, recoveries. We make mistakes from time to time. It's inevitable. Here's our default stats. Our overall platform, since inception, it's had a 1.4% default rate versus IvyFON 4.3%. First lien loans at 1.5%, substantially lower than the market. And then our recoveries have been substantially higher. We've recovered 77 cents on the dollar when we had a defaulted loan versus, let's say, 59% for the overall market. So that does make a meaningful difference. Over the 14 years, our average default rate's been a lot lower than market. And then at the peak, which was the peak leverage loan default rate was about 10%. At the end of 2008, we had a 0.5% default rate. That was in the middle of the global financial crisis.
Great. We have another question?
I was curious, you mentioned you go right on. What percentage of the equity stacks generally take up more is ideal for your life?
So the question is, what percentage equity do we take up? What's ideal for the organization? So typically when we look at a vehicle, we say that we want it to be 90% to 95% debt and 5 to 10% equity co-invest. So that's how we think about portfolio management. And then it just depends case by case on the deal. And that's the nice thing. Sometimes we will graciously decline an equity co-invest opportunity because we like the debt. The debt's safe. We think the equity may not represent the greatest value. In other cases, we say, gee, the debt's really interesting and the equity is super interesting. We're going to try to negotiate for a bigger piece of the equity. So that's in a way how we can modulate the risk return. I'd say it's just kind of off the cuff, the equity bites that we take are around 5% of the debt bites that we take in an average vehicle. Does that answer your question? Yes. Thank you.
We have time for like a question or two more.
Quick one, do you have an offshore vehicle as well?
We do, and we're going to continue to do more offshore structures.
When did your offshore vehicle start?
3 years ago. So we make ourselves very investor friendly. The question was about offshore vehicles. We want to listen to what our investors want, then we'll create sleeves that meet their needs. Most important thing is, does our strategy make sense for the investor? Then we want to kind of be very flexible around structure.
Great. Last question.
If they change from LIBOR to SOFR, going to affect the way you structure.
Yeah, it's a great question. Questions LIBOR, SOFR, we're living through that as we speak, right? Every day. Hopefully the next 6 months things will settle down. There's a big gap between LIBOR and SOFR.
Yeah.
So today, we are negotiating SOFR plus an adjustment plus the spread. So SOFR plus 15 or SOFR plus 25
Yep.
plus the spread. That's what's being negotiated today. Most of our loans today have floors. Today they're LIBOR floors. They will be SOFR floors. So no matter where LIBOR or SOFR is, it's 700 over a floor of 1%. So even if LIBOR or SOFR below 1%, we're getting that floor. So it's changing. Hopefully things will kind of settle down in 6 months or so. Anything else today? Any other questions? I'll be around later. Really appreciate your time. And Marty, thank you for.
Perfect. You're going to be here at dinner too?
Yeah.
Oh, fantastic. So you have more questions. This is actually a fascinating area. My only question is, back in 2008, the sector was what, 500 billion or so, and now it's much larger?
I think in 2008 it was a lot. It was probably a lot less. Probably a couple hundred.
100 billion, yeah.
A couple $100 billion is probably now about $1 trillion.
Amazing. Yeah. So there's been a lot of growth in this sector. Fantastic. Thank you so much.
Thank you.